Imagine a simple game. You hold a coin in your hand. Each time you flip it, there's a 50% chance of heads and a 50% chance of tails. Sounds fair, doesn't it? Yet in the financial markets, where every trade can feel like flipping a coin, most traders still fail. They don't just lose a few trades, they can lose their entire account, sacrificing time, money, and even self-confidence. The problem doesn't lie in the market, but in their mindset. Trading isn't just a 50-50 probability game. It's a tough battlefield where traders must confront fear, greed, and emotional pressure. A single impulsive decision or lack of discipline can cost dearly. In fact, one losing trade can erase the profits of dozens of winning ones if proper risk management isn't in place. This is why you need to watch this video to the end. I believe what I'm sharing today will give you a completely fresh perspective on trading, insights and subtleties that no one has told you before. Watch until the end, and I'm confident you'll gain real value to help you advance further on your journey to mastering the financial markets. Don't forget to hit like, share this video to spread valuable knowledge, and subscribe to our channel so you don't miss out on future content. The financial markets are not just a place to flip a coin and hope for luck. In reality, they are a harsh battlefield where you face challenges not only from price movements, but also from your own psychology. So, what makes most traders fail? Let's start with the first and most common factor: trading psychology. Trading psychology, the influence of screen colors on emotions. The psychology of trading can easily be affected by seemingly simple factors, such as the colors displayed on trading screens. When you open your trading platform, the numbers constantly moving in two primary colors, green and red, are not just market signals. They are powerful triggers that can influence your emotions and decisions. According to psychological studies, the color red can stimulate physiological reactions in the body, increasing heart rate. This natural mechanism is the body's way of responding to stressful or dangerous situations. As a result, when traders see their accounts in the red, feelings of fear and anxiety are immediately triggered. These emotions often lead to poor decisions, such as cutting losses too early, abandoning trading strategy, or engaging in reckless trades to recover losses. Conversely, the color green, representing profit, brings a sense of excitement but can also lead to overconfidence and greed. Seeing profits grow, traders might hold on to trades for too long, expecting even larger gains, without realizing the potential risks of sudden market reversals. How to mitigate emotional impact while trading? To minimize the psychological impact of the green and red on trading platforms, I follow a simple yet effective method. I avoid opening the trading platform or website while trades are active. By not watching the live status of trades, I reduce stress and avoid being influenced by minor market fluctuations. This approach allows me to focus on the plan I've established rather than reacting emotionally. Instead, I analyze charts on a separate analytical platform, keeping it distinct from my trading platform. This separation helps me maintain focus on technical analysis and monitor market trends without being distracted by account balances or trade statuses. When emotional conflict is removed, decisions are made more rationally rather than impulsively. Avoid checking your trades too frequently. Markets fluctuate constantly, but not every change requires your intervention. Separate analysis platforms from trading platforms. This creates the necessary distance between you and the emotional triggers associated with account performance. Stick to your trading plan. Regardless of market volatility, let your trades breathe according to the strategy you originally set. Managing trading psychology involves more than just controlling emotions. It's also about creating an environment that supports rational decision-making. When you control the factors that impact your emotions, you'll find that making decisions becomes much easier and more effective. The market is a test of discipline, but with a few small adjustments in your approach, you can turn stress into opportunity. After understanding how emotions are influenced by colors and trading environments, it's clear that managing emotions is vital yet challenging. However, controlling emotions alone is not enough. Another critical factor, often overlooked, is risk management. Risk management, the shield that protects your account. Risk management is not just a skill, it's a survival principle in financial trading. In previous videos, I've mentioned that risk and capital management won't make you rich overnight, but they are the secret weapons that allow you to survive and thrive in the market. Surviving longer means you have more opportunities to accumulate experience, improve your skills, and ultimately increase your chances of long-term success. A common mistake among many traders is underestimating risk management and focusing solely on profits. They take on excessive risks per trade, believing that one big win can change their lives. However, the harsh reality is that just one losing trade can wipe out everything, even reducing your account to zero. Imagine you have a $1,000 account. If you risk 20% of your account per trade, $200, your account is almost completely wiped out. On the other hand, if you risk only 1-2% of your account per trade, $10, $20, you still have enough room to learn, recover, and continue trading without losing your entire capital. Rules from successful traders. Set a clear stop loss. Determine your stop loss level before entering a trade and stick to it strictly. This protects you from unexpected losses. The 1-2% rule. Never risk more than 1-2% of your total account per trade, even when the opportunity seems guaranteed. This ensures you can withstand a streak of losing trades while preserving your account. Focus on risk-reward ratio. Only take trades with a risk-reward ratio of at least 1/2, ensuring that one winning trade can offset several losing ones. Remember, risk management is not about avoiding losses, but about controlling losses and protecting your trading capital. The market is highly volatile, and success doesn't come from scoring big wins, but from your ability to sustain your account through, quote, turbulent waves. When you practice serious risk management, you not only protect your capital, but also gain opportunities to learn and accumulate experience in the market. Every trade becomes a valuable lesson, helping you improve over time. Success in trading is not a get-rich-quick story, but a journey of patience, discipline, and growth. So, lay a solid foundation for yourself by practicing effective risk management starting today. In the next section, we'll discuss another crucial factor, a trading plan, the compass that guides you through the market's fluctuations. Once you understand the importance of risk and capital management, you'll see that they are the keys to surviving and enduring in the market. But survival is just the beginning. To truly advance and achieve greater financial goals, you need a clear compass, a well-structured trading plan to guide you through all circumstances. And that's the next important factor, your trading plan. Trading plan, the compass for your financial journey. Trading without a plan is like trading blindly. A clear trading plan not only guides you through the market, but also keeps you from being swept up in emotional spirals and impulsive decisions. A good trading plan includes clear objectives. You need to know what you aim to achieve with your trades, how much profit, within what time frame, and the level of risk you are willing to accept. Rules for entry and exit. Under what conditions will you enter a trade? When should you exit to secure profits or minimize losses? Time frames and tools. What time frame will you trade on? What tools or methods of analysis will you use to support your decisions? Imagine you are following a trading strategy with a risk-reward ratio of 1:2, meaning you risk $50 but aim for $100 profit per trade. With this plan, you know that even if you win only 40% of your trades, you can still be profitable. Such a plan builds confidence and helps you stay composed when the market moves against you in the short term. Why is a trading plan important? A trading plan not only helps you make better decisions, but also protects you from impulsive actions. Without a plan, it's easy to let emotions take over, for example, cutting losses too early out of fear or failing to secure profits out of greed. Conversely, a clear plan ensures discipline, reduces mistakes, and improves your overall trading performance. Tailored to your needs. Don't copy someone else's trading plan. Instead, create one that suits your trading style, time frame, and financial goals. Review and adjust. The market is constantly evolving, so your plan needs to be reviewed and improved periodically. Stick to discipline. A trading plan is only effective if you adhere to it. Don't let emotions or market temptations break your rules. No trading plan is perfect, but having one is far better than having none. Think of your plan as a compass. It may not provide all the details, but it will certainly keep you on the right path. Perfection is unattainable, but a clear plan serves as a steady guide to navigate the complexities of the market. However, a plan is only effective when you understand how to implement it in practice and avoid common pitfalls. One of the biggest mistakes traders make, especially beginners, is using too many technical tools without fully understanding how they work. This not only complicates the trading process, but often leads to inaccurate decisions. To progress further, it's essential to simplify your trading system and focus on effectiveness rather than unnecessary complexity. Lack of knowledge and overcomplicated tools. Many traders, especially beginners, often get caught up in using too many technical tools, thinking that the more indicators they use, the more accurate their trades will be. However, this is a critical mistake that leads to overly complex, inefficient decisions and even a loss of direction. A simple trading system that is well understood and correctly applied is far more effective than using numerous tools without understanding how they truly work. Focus on simplicity and understand the strengths and weaknesses of your system. For me, simplicity is always the key. I use the Heiken-Ashi system, but I don't apply it randomly. My system follows clear rules designed to mitigate potential weaknesses. Entry on the third candle, provided the second candle has a long body with no wicks. This helps filter out noise, especially during sideways markets. Trading only major currency pairs, as minor pairs often lack liquidity and exhibit erratic behavior, reducing the system's effectiveness. Focusing on daily, weekly, and monthly timeframes, as these are less noisy, allowing me to hold trades longer and analyze the market with more clarity. Drawing inspiration from crocodiles' patience and understanding the environment. One of the most inspiring images for me in trading is that of a crocodile, the master predator. I always remember how a crocodile takes advantage of deep waters to ambush a herd of wildebeests crossing the river. The crocodile knows that deep water is its ideal environment, where its strength and advantage are maximized. On land, however, it becomes slow and vulnerable, unable to showcase its power. Similarly, in trading, you need to identify the environment where you have the greatest advantage. For me, that environment is trading on longer time frames with major currency pairs, where my Heiken-Ashi system performs best. If I try to apply this system to shorter time frames or minor currency pairs, I would be like a crocodile hunting on land, lacking strength and prone to failure. A set of rules, the pillars of trading discipline. To avoid getting caught up in unnecessary complexity or trading in unfavorable conditions, I always adhere to a clear set of rules. Define ideal conditions. Trade only when the market aligns with the criteria of your system, such as clear trends and no sideways movement. Simplify tools. Use only essential indicators to support analysis, avoiding the clutter of too many tools that can overwhelm. Regular evaluation and optimization. Periodically review your system to identify weaknesses and make necessary improvements. The market is constantly changing, but the most important thing is to understand your system, when it works best, what its strengths are, and what weaknesses need addressing. Like the crocodile, you need to know your deep water, the environment where you have the most significant advantage. Don't let unnecessary complexity or the feeling of needing more tools derail you. A simple system tailored to your trading style is the key to long-term sustainability in the financial markets. A trading plan and a simple, effective system as the foundation. A clear trading plan and a simple, effective system are essential foundations for success in the market. But even that is not enough. Your trading habits also play a crucial role in determining success or failure. Many traders fail not because they lack a strategy, but because they lack good trading habits, particularly when it comes to overtrading, trading excessively without clear justification. In a previous video, I discussed overtrading and its harmful effects. You can revisit that video in the playlist linked below the description to gain more insight. Unhealthy trading habits. Common mistakes traders make. Overtrading. Always wanting to be busy in the market. Overtrading is one of the most dangerous trading habits many traders fall into, especially beginners. You may feel the need to constantly place trades to not miss opportunities, or to prove that you're making the most of your time. However, in reality, trading too often can drain both your finances and mental energy. Remember, the market does not always present good opportunities. When you try to force the market to meet your trading demands, you are more likely to make mistakes and execute low-quality trades. Overtrading often results in consecutive losses, diminishing your confidence and trapping you in a cycle of uncontrolled trading. Lack of patience. Failing to wait for good opportunities. Another reason for unhealthy trading habits is impatience. Many traders lack the calmness to wait for clear signals or market conditions that align with their strategies. Instead, they rush into trades simply to feel like they are doing something, which often results in unnecessary risks. For example, if you follow a trend-based strategy, but the market is moving sideways, placing trades in such conditions out of impatience will likely lead to losses. Patience in waiting for good opportunities is not a waste of time. It's a way to protect your account and trading psychology. How to build healthy trading habits. Set clear criteria for each trade. Before placing a trade, ensure it meets all the criteria outlined in your trading plan. If not, patiently wait for better opportunities. Limit the number of trades. Set a daily or weekly trade limit and only trade when the market conditions genuinely fit your strategy. Monitor and evaluate your habits. Keep a trading journal to identify unhealthy habits and make timely adjustments. Take breaks. Don't feel like you need to trade all the time. The market is always open, and constant activity is not necessary for success. Focus on long-term success. Trading is a long-term game, and success doesn't come from the number of trades you place, but from their quality. Be patient, avoid overtrading, and develop healthy trading habits. The market will never run out of opportunities, but you can only capitalize on them if you maintain discipline and focus. The importance of patience and discipline. Patience and discipline are essential for trading success, but not everyone realizes this from the start. Initially, I thought trading had to look professional, with multiple screens, advanced devices, and an impressive setup. However, over time, I realized that these were unnecessary and sometimes even added pressure. I also learned a significant lesson from frequently checking the trading screen, which not only affected my psychology, but also led to impulsive decisions driven by greed. With experience, I understood the value of simplicity and calmness in trading. By adopting healthy habits and focusing on long-term goals, I was able to overcome these challenges and become a better trader. Impatience and greed, common mistakes of traders. Many traders, especially beginners, enter the market with the expectation of getting rich quickly. They are drawn in by images of luxury cars, lavish lifestyles, and the promise of financial freedom portrayed in advertisements. This creates an invisible pressure, driving them to trade with the desire to achieve success quickly, without realizing that trading is a long-term journey that requires patience and discipline. Checking trading screens too often when greed takes over behavior. At the beginning of my trading journey, I also made this mistake. Constantly checking the trading screen to track every price movement not only made me anxious, but also allowed greed to take control. When my account was in profit, I wanted to trade more to earn even more. When my account was in loss, I wanted to jump back into the market immediately to recover. Especially when my account balance was flush with cash, the urge to trade became even stronger, leading to poor decisions. It's hard to believe that constantly checking the trading screen can have such a significant impact on psychology and behavior, especially when there is a substantial amount of money in the account. But after enduring a series of losses and stressful days, I decided to take a long break from trading. During that time, I was fortunate to learn some critical mindsets that helped me become more aware of when I was making mistakes and how to adjust my behavior. When I returned to the market, I was no longer haunted by the trading screen, and my trades improved significantly. Glamorous imagery, tricks of the marketing industry. I'm fortunate to work in the marketing field, which has allowed me to understand the tactics and tricks used to target the psychology of traders. Glamorous images of luxury cars, extravagant lifestyles, and beautiful models are often designed to be embedded in the viewer's mind, creating the illusion that trading is the shortest path to wealth. These images not only legitimate the idea of wealth in trading, but also make traders more susceptible to falling into a cycle of greed and pressure. They are dangerous because they cause you to forget the reality that trading is a long-term endeavor where stability and psychological health matter more than anything. I was lucky to recognize this and eliminate these illusions from my mindset. The ultimate value of trading. After everything, I've come to realize that, in the end, success in trading is not about outward glamour, but about inner balance. You need more than just money. You also need family, health, and other meaningful aspects of life. Take time to be with your loved ones, focus on your health, and care for yourself. Trading can bring wealth, but if that wealth comes at the cost of illness or loneliness, it loses its meaning. Ultimately, the true goal of trading is not just wealth, but wealth in good health and happiness. Don't let extravagant dreams or societal pressures make you forget this. The market will always be there, but your time and health won't. I wish you success in trading, and don't forget to regularly return to my YouTube channel. I believe that every time you rewatch videos you've already seen or heard, you'll discover new insights and subtle lessons to help you advance further on your trading journey. Thank you for accompanying me, and I look forward to seeing you in the next video.